the mix of the debt and equity that a company uses to finance its operation and growth. It includes long-term debt, short-term debt, common equity, and preferred equity. The goal is to find the optimal balance that minimizes the cost of the capital and maximize the firm value. Next, other advantages of capital structure, which is a first cost effectiveness. This is realized through the reduction of cost of capital. Reduce the cost of capital through the debt financing, which is debt is cheaper than equity as lender require a lower rate of return due to lower risk, which it can higher claim on asset during the liquidation. By carefully balancing debt and equity, a company can minimize its weighted average cost of capital and it can increase its valuation and it can attract to investor. The second benefit is tax benefit, which is the concept of the tax benefit it in capital structure revolve around the tax shield provided by the reduction of the interest payment on loan and bonds. Interest payment on loan and bonds are tax deductible, so reducing the taxable income, it can minimize the company's tax burden increase after tax earning. Extra saving from the reduced tax can be reinvested for growth or distributed as a dividend. The third advantage is a financial flexibility. Capital structure provide a company with the financial flexibility to weather economic protection and capitalize on its growth opportunity. Maintain a balance between debt and equity to ensure the liquidity and access to capital. Equity acts as a buffer during the economic downturn and protecting the company from a financial stress. Debt enables quick access to fund for investment, expansion, or acquisition. The fourth advantage is maximizing the shareholder value. Lower cost of capital and financial flexibility, it can increase the profitability. And then the higher return on equity improve the growth prospect and result in higher share price and dividends, building long-term investor confidence. Then the disadvantages of capital structure is the first, financial stress and bankrupt risk. Higher debt increase financial risk due to mandatory interest and principal repayment. If a firm experiences weak cash flow or declining revenue, it may not be able to meet those obligations and could experience financial stress and or bankrupt. High debt reduce the flexibility, strain operation, and lower the investor confidence. The second disadvantage is decrease in financial flexibility, which is a high debt limit the ability to finance the new investment or handle unexpected expenses. Firms with a high debt are viewed as a credit risk, reducing the future borrowing capacity. Debt often comes with a restrictive covenant limiting the operational decision. And the third disadvantage is the interest rate risk. Variable interest rate can increase the cost, reducing the profitability and cash flow. Higher expenses strain the financial resource and impact growth investment. Uncertainty in borrowing costs limit the financial predictability and flexibility. The fourth disadvantage is dilution of the ownership, which is equity financing. Issuing new share dilute ownership of a reduced control of the existing shareholder, which it can decrease earning per share (EPS) and shareholder return. Equity financing avoid the debt risk but impact shareholder power and share value. Next, I will explain about the dividend policy. Dividend policy refers to the strategy or approach a company uses to decide how much of its earning will be distributed to shareholders as a dividend and how much will be retained for reinvestment in the business. The advantages of the dividend policy is first, it can increase the shareholder value. Pay out dividend as a direct incentive for the shareholder. It improves their satisfaction and encourages the longevity of the shareholder. Consistent dividend build an investor confidence and attract a stable shareholder base. The second advantage is a signaling financial health. Regular dividend payments show shareholder that the organization is supplying adequate fund from the net profit and from the sales of other assets needed for sustaining the business investment requirement as well as continued distribution of the dividends. Communication of this signal can improve the firm's credibility within the financial market, attract more investors, and this in turn raise the firm's stock price. The business organization that maintains state a dividend policy for its shares as usually considered to be solid and financially stable and such as their market value increase. The third advantage is promoting the financial discipline. A dividend policy can help the company maintain a financial discipline. Due to commitment to paying their regular shareholder dividend, the firm are to be very conscious in their expenditure or take a high risk. This disciplined approach helps to ensure that all the funds presently available for use are well employed and enhance the business and firm stability. The fourth advantage is it can attracting a wider range of investors. A clear and well-articulated dividend policy is a plus to the company because it will be able to attract a lot of investors because of its flexibility to accommodate the different investors. Some prefer a higher dividend while others prefer growth in their stock price. Next, the disadvantages of the dividend policy is first, it can reduce the flexibility. A strict dividend policy decreases a company financial flexibility as it requires consistent and significant cash payout to shareholder, therefore limiting the fund available for unexpected expenses or strategy investment. Economic slowdown or industry disruption sometimes the force company to retain cash for sustaining operation or capitalizing on opportunity, which may not be possible with a regular dividend commitment. This may force the company to rely on external financing, increasing the financial risk and cost or miss out on growth opportunity. It is very important to balance the shareholder expectation with a financial adaptability in order to avoid these challenges. Next, the second disadvantage is financial strain. Maintaining a consistent dividend policy can impose a significant financial strain on a company, especially when the company is in a bad economic time or period of reduced profitability. And the third disadvantage is volatility of the shareholder expectation. The dividend policy can add to volatility in shareholder expectation, which is after a company has established a pattern of paying consistent dividend, investors begin to rely on those dividends. When there is a reduction or suspension of the dividend, which may be justified by economic downturn or reinvestment needs, investors lose confidence and may react negatively in the stock market. This volatility can lead to damage in reputation and a loss in shareholder relationship. Lastly, the last disadvantage is it can decrease in reinvestment. The disadvantage of the high dividend payout policy is that there is generally a low level of reinvestment. When all or most of its earnings are paid as a dividend, a company has limited fund to invest back into the business, and it reduces the competitiveness and adaptability in the long run.
Let me introduce Kind Holdings Berhad, a name similar with quality and innovation. Established in 1961 as Syarikat Elektrik Kihin by Cheng King Fa, Kind has become one of Malaysia's leading manufacturers and distributors of electrical appliance and industrial solutions. With operations in over 60 countries, the company runs a modern factory in Selangor and 11 offices across Malaysia. Product includes household essentials like fans and kitchen appliances under the Kind and Mistral brands, along with premium global names such as KitchenAid and Honeywell. The industrial divisions provide transformers, cleaning equipment, and air cooling system tailored for commercial use. Question 1. How do companies make decisions regarding their capital structure and dividend policy, and what current practice are they employing to optimize their financial performance? Here's how the companies decide on capital structure and dividend policies. Capital structure decisions involve balancing internal factors like cash flow and equity growth with external ones such as market conditions and shareholder expectations. For example, Kind reduced its debt-to-equity ratio from 0.33 times to 0.27 times by cutting borrowings from 67.2 million ringgit to 57.5 million ringgit. This move lowered financial risk and reduced interest costs. For dividend policies, aim to balance financial stability with rewarding shareholders. In 2023, Kind paid an 8 cent per share dividend, achieved a 47% payout ratio despite challenges in previous year. The strategic goal is clear: reduce debt, grow equity, and ensure a strong liquidity position to maintain stable dividend. Let's look at the current practice companies use to optimize financial performance. Kind focus on reducing debt while increasing equity, which strengthens its financial position and creates a stable foundation for growth. The company also invests in technology like AI and data analytics to improve decision making and cash flow management. Sustainability efforts, such as using renewable energy, help reduce costs and improve efficiency. By adopting a direct-to-consumer model, Kind enhanced profit margins and reduced its reliance on external financing, ensure more reliable dividends payout for shareholders. Through this strategy, Kind's balanced growth, efficiency, and shareholder returns ensure long-term success.
Next is question 2. Can you explain the factors that influence a company's choice of capital structure, and how have recent economic conditions affected this decision? Provide examples of companies that have recently adjusted their capital structure in response to changing market conditions. The factors that influence a company's choice of capital structure. Balanced capital structure. King's Holding Berhad showcased a strategic approach to balancing debt and equity financing. Leverage the tax benefits of debt through interest expense deduction. Maintain a manageable debt to equity ratio of 0.61, reflecting cautious financial planning. Ensure steady repayment capacity due to consistent revenue streams for core business operation. Reduce risk associated with high leverage, safeguarding the company's financial health. Support both short-term operational needs and long-term growth objectives with a stable capital foundation. Number 2 is strategic decision making. The company's capital structure decisions are influenced by internal and external factors. Internally, it prioritizes maintaining control by minimizing shareholder dilution through equity issuance. Cash flow reliability allows for sustainable debt management without risking defaults. Tax efficiency is maximized by using debt financing to reduce overall borrowing costs. Externally, Kin adapts to favorable market conditions, such as low interest rate environment. Industry-specific dynamics and competitive pressures shape a flexible and responsive financial strategy. Next, how have recent economic conditions affected this decision? Number 1 is influence of economic factors on capital structure. Interest rate fluctuation. Low rates encourage debt financing, while high rates lead firms to reduce leverage. Inflationary pressure, rising costs can strain profitability, making debt servicing more challenging. Economic uncertainty. Firms often prioritize equity financing to maintain stability and reduce default risk. Geopolitical and supply chain disruption. These external factors necessitate cautious financial strategy to safeguard operation. Post-pandemic adjustment, recovery effort require firms to adapt funding strategies to align with evolving market conditions. Number two is Keynes Holdings Berhad strategic response. Maintain a balanced debt to equity ratio of 0.61 to manage risk and leverage opportunities. Relies more on equity to shield against interest rate volatility and financial instability. Demonstrates strong debt management with an interest coverage ratio of 3.24, ensuring the ability to meet obligation, minimize financial stress during inflationary periods or supply chain challenges by maintaining low debt levels, prioritize long-term growth and stability, enabling resilience in fluctuating economic conditions. Next, example of companies that have recently adjusted their capital structure in response to changing market conditions. First is Panasonic resilience through strategic debt issuance. Issue bonds to leverage low interest rate, ensuring liquidity while preserving its equity base. Use bond proceeds to sustain operation and invest in high growth areas like energy solution and EV batteries. Opted for debt instead of equity to protect shareholder value during uncertain times. Maintain cash reserve for innovation, safeguarding its competitive edge in clean energy and smart technologies. Position itself for post-pandemic growth by balancing short-term financial needs with long-term strategic investment. Number two is Asia's survival through equity and debt financing. Raise significant capital through a rights issue and share placement, generating vital liquidities despite equity dilution. Restructure debt to extend repayment timelines and manage immediate cash flow challenges. Maintain operation by financing critical expenses, including aircraft leases and employee salaries. Balance immediate survival with long-term sustainability through diversified capital raising effort. Ensure readiness for recovery as travel demand rebounded, setting the stage for a gradual comeback.
Question number 3. How the company decide on their dividend policy and what factor do they consider when determining how much to pay out to shareholder? Provide an example of company that have recently changed their dividend policy and what drove this decision. Let's see how the company decide on their dividend policy. Dividend policy is an important element of a company's financial strategy, influencing the investor perception and impacting overall market valuation. First of all, the most important component to consider when developing a dividend policy is a profitability. Firms with a stable profit are more likely to distribute a dividend regularly, while those with uncertain earning may choose to retain more earning for operational security. For example, the Kind Holding Berhad report a decline in profit before tax from 21.4 million ringgit to 9.5 million ringgit in financial year 2023, mainly due to unfavorable market conditions. Next, investment opportunity significantly influence the dividend policy. Firms can reinvest their earnings into growth in an initiative rather than distributing them as a dividend. For example, the Kind Holding Berhad management is emphasizing investment in technology and upskilling of the workforce, among others, all as ongoing initiative in its transformation journey. Third, the cash flow indicates the financial health of a company and is one of the most important to decide on dividend policy decision. A company need to have a strong cash reserve to support the dividend payment. Kind Holding Berhad recorded improved cash flow performance in the financial year 2023, with cash and cash equivalent increasing to 61.9 million ringgit. This increase, along with a reduction in borrowing, enabled the company to declare a dividend of 8 cents per share. Such results highlight the importance of maintaining a liquidity to meet our operational needs and shareholder expectations. Lastly, the wider economic environment is another key determinant of the dividend policy. During the economic uncertainty, the firm may reduce the dividend to preserve cash while stable conditions encourage higher payout. For example, the Kind Holding Berhad faced external challenges such as a trade tension and geopolitical conflict and emphasizing the Next, what factor do they consider when determining how much to pay out to shareholder? When deciding how much to distribute to shareholder, the company's profitability is a major consideration. Higher profit may lead to increased dividend, while lower profit may result in reduced payout. Can report a net profit of 7.60 million for the year 2023, which was a considerable decrease from the prior year. The business paid out 3.36 million ringgit of 47% of its net profit in dividend in spite of this decreased profitability. This choice demonstrates the kind dedication to upholding the shareholder trust and allocating a fair amount of profit. In addition, a cash flow is essential to decide the dividend payout. Cash flow from the operation is an important factor because business must have enough the cash on hand to pay the dividend. The ability of the business to pay a dividend is significantly influenced by its liquidity. In the financial year 2023, the kind cash and cash equivalent amounted to 61.9 million ringgit, increased from 54.2 million ringgit in the financial year 2022. Despite the falling earning, this better cash flow highlight the company prudent financial management, which allow it to satisfy the shareholder expectation as well as the operational demands. Next, the kind holding berhad determine its dividend payout by considering the analysis of dividend policy, such as a dividend payout ratio, dividend yield, and return on equity (ROE), to balance the shareholder return with a financial sustainability. Other than that, to determine the dividend payout to shareholder, company like Kind balance shareholder reward with the need for reinvestment in the business. Firm prioritize capital expenditure and reinvestment in technology and capacity expansion to ensure the competitiveness and long-term growth. Example, the kind allocate a 5.3 million ringgit for technology and operational upgrade in financial year 2023. Next, the market condition and the largest economic environment is one of the factor to consider when determining how much to pay out the shareholder. Business may retain the more of their profit amid uncertain or declining economic time. External factors like inflation and geopolitical tension impact the dividend decision. For example, the kind have a 10.9% sale decline in financial year 2023, lead to question dividend allocation to maintain a financial flexibility. Example of company recent changes in dividend policy. The first example is Powerwell Holding Berhad. The changes is increased dividend to 3 cents per share in financial year 2024, including the interim payout. The reason is it have a strong profit before tax and a strategy to enhance the shareholder value while ensuring the financial resilience. The second example is a Sime Darby Plantation Berhad. The changes is reduce the dividend to 8.95 cents per share in financial year 2023. The reason is a 53.2% decline in net profit due to lower palm oil price and higher operation expenses. The third example is Intel Corporation. The changes is because of the reduced dividend by over 65% to 0.125 per share in 2023. The reason is reallocation of fund for investment in chip production and technology to remain the competitive in the tech sector.
Now we proceed to the next question. How do companies balance their need for growth and investment with their obligation to pay dividend to shareholders? And can you provide example of company that have successfully managed this balance and how they have structured their capital and dividend policy to achieve their goals? The current holdings Berhad companies balance their need for growth and investment with their obligation to pay dividend to shareholders is first is implement effective cash flow management. Kind Holdings Berhad ensure efficient use of its cash flow by implementing stricter control over purchases and inventory, which helps to reduce unnecessary costs such as storage and inventory management. For example, in 2023, this effort allowed the company to pay an interim tax-free dividend of Rm 3.36 million, while maintaining cash and cash equivalent of Rm 61.9 million, and increased from Rm 54.2 million in 2022. So what's the impact for this? This strategy ensures efficient liquidity to make short-term obligation, pay dividend to shareholder, and reinvest in the business to fuel growth. Okay, number two is reduction of loans. Kind is committed to lowering its financial liability to improve flexibility and reduce costs associated with loan interest. For example, the company reduced its loan from Rm 67.2 million in 2022 to Rm 57.5 million in 2023, reflecting effective debt management. So what the impact? The impact is the Kind Holdings Berhad which is a reduction in loan debts to saving on interest costs and improve debt to equity ratio from 0.3 to 0.27, strengthening Kind's financial stability and allowing more resources to be directed towards strategy immediately. Number three is strategy investment in asset. Kind Holdings Berhad continues to invest in its operational infrastructure to support long-term growth and enhance its market position. For example, in 2023, despite a decline in revenue and profit, Kind invested in the renovation of facility and the purchases of new branch equipment. So the impact is this investment improve the company's operational capabilities, preparing it to capitalize on future growth opportunity while maintaining its ability to provide dividend to shareholders. Okay. The companies that have successfully managed this balance is Panasonic Holdings Corporation and Microsoft Corporation. Okay, so how they have structured their capital and dividend policy to achieve their goals? Okay, first we look at the Panasonic Holdings Corporation. Okay, Panasonic company balance capital distribution. Okay, Panasonic ensure the healthy debt to equity ratio. It has maintained financial flexibility by maintaining as well managed balance between debt and equity. The company is able to optimize its capital structure. This strategy allows the company to maintain access to capital while reducing the financial risk associated with excessive debt. Okay. So, number two is a strategy use of debt. Rather than relying heavily on debt financing, Panasonic used that strategically to invest in higher return projects that align with its long-term growth plans. These approaches allow the company to fund important initiatives such as a green technology, renewable energy solution, and electrical vehicle battery while controlling the risk tied to higher leverage. Number three is dividend policy and payout ratio. Panasonic aims to provide stable and consistent dividend to shareholders while also ensuring sufficient capital for reinvestment in strategic priorities. The company adjusts the dividend payment based on its profit and overall financial health. By doing so, Panasonic maintains a balanced dividend payout ratio that reflects the company's current performance and structured growth prospect. In fiscal year 2023, for example, Panasonic declared dividend based on available net income, while ensuring that enough funds were allocated for strategy investment in areas such as R&D and sustainability. Lastly, is investment in long-term growth area. Panasonic continues to invest in sectors such as energy solution, including the EV battery, hydrogen energy, and renewable energy system in alignment with global trend and its sustainability goals. This investment ensures that Panasonic remain competitive in the long run and can tap into growing markets that are essential for future growth. Microsoft company balance their capital management. Microsoft employs a strategic approach to capital management, ensuring a balance between the use of debt and equity. This balance helps the company maintain financial stability while allowing flexibility for growth. While Microsoft traditionally relies more on equity, particularly retained earnings and strong cash flow, the company also utilize debt when necessary. By issuing bonds, Microsoft takes advantage of low capital cost with strength in financial position without over leverage. Number two is focus on retained earning and cash flow. A significant part of Microsoft capital structure is driven by its retained earning, which are generated from strong cash flow. In the case of major investment like the expansion of its cloud service through Azure, Microsoft used internal sources of capital such as retained earning to fund the project. These approaches ensure that the company doesn't excessively rely on external debt, maintaining its financial independence and stability. Number three is share buyback program. Microsoft actively participates in share buyback program, returning capital to shareholders while maintaining financial flexibility. In fiscal year 2023, Microsoft returned 38.6 billion to shareholders, which include 20.3 billion in dividend and 18.3 billion in share repurchases. The share buyback reduced the number of shares understanding, which increased earning per share and signal confidence in the company's future performance. This move benefits shareholders by potentially increasing stock price and offering higher return without creating long-term obligation like dividend. Lastly, is consistent and growing dividend policy. Microsoft has a consistent track record of increasing its dividend, reflecting strong profit and stable cash flow. Since it began paying dividend in 2003, the company has regularly raised its dividend payout. For instance, in the fiscal year 2023, Microsoft increased its quarterly dividend by 10% from 0.68 to 0.75 per share. This shows the company's ability to provide stable return to shareholders while maintaining funds for reinvestment in higher priority innovation areas like cloud computing and AI.
Next is we go to recommendation. For the first is how to optimize the capital structure. Firstly, how to optimize capital structure, Kind need to maintain their balanced debt equity mix. This approach allows Kind to leverage benefits of debt financing, taking advantage of lower interest rates while mitigating the risk of the over-reliance on debt, which could increase financial strain during the economic downturns. Next is using retained earnings as a means of internal financing to foster growth rather than depending heavily on the external funding. This strategy also to ensure that cash flows are effectively allocated among reinvestment in the business that will reducing the existing debt and paying dividends. Retained earnings serve as a non-dilutive source of capital, which is will support long-term growth while safeguarding shareholder value. Lastly, the recommendation is remain flexible in adjusting the capital structure based on the changing market conditions, which means in the period of low interest rate, the company may increase its debt to capitalize on favorable borrowing repayment. Favorable borrowing costs. Next is regarding its dividend policy. For the first recommendation is maintaining stable dividend, which is essential for building shareholder trust and reinforcing the company's financial health. However, to maintain flexibility, Kind should also implement a flexible dividend payout ratio, which this allow the company to adjust the dividend payments in response to factors like cash flow, profitability, and capital reinvestment needs. Second, the recommendation is Kind should consider a cyclical approach to its dividend policy that aligns with the overall economic climate. This will adeptly enables Kind to avoid overcommitting to dividends during the challenging periods. Lastly, the recommendation for the dividend policy is clear communication with the shareholders about any changes to the dividends policy is vital. This is to maintain the confidence, especially when the company adjusts its dividends payout to support the strategic growth. Transparent explanation about the reinvestment priorities, such as entering new markets or developing a new products, will help to mitigate potential concerns and demonstrate a long-term growth visions. Lastly, as for the conclusion, Kind must continue to strike a balance between dividend payments and investments to aim at long-term growth with prudent financial management, debt reduction, and strategic investments, Kind is well equipped to achieve sustainable success while delivering consistent returns to its shareholders. So that's all from us. Thank you.